Good day, welcome to Buchi Accounting Tutorial. If this is your first time of coming across this channel, please endeavor to click the subscribe button and turn on the notification bell so that each time we upload new video, you will not miss out. So, the topic we are going to look at is accounting equation. In my previous video, we talked about 5 elements of financial statements. And we may mention that the 5 elements of financial statements are 5 elements. Sorry. We say that 5 elements of financial statement are: one is assets. We have liabilities, and we have capital. We have revenue, and finally we have expenses. So these are the 5 elements of financial statements. We have assets, we have liability, we have capital, we have revenue and expenses. These are the 5 elements of every financial statement. And these first 3, assets, liability and capital, are usually represented in the statement of financial position or balance sheet, while these last 2, revenue and expenses, are usually treated in the income statement. Therefore, these 3 now are the components of the accounting equation. In the first place, the meaning of an accounting equation is just a proposition that the asset of a business entity should be equal to its capital and liability. And the fundamental of the equation is that assets equals to capital plus liability. Then from here now you can see assets, liability and capital, and they are the components of the accounting equation, because balance sheet is the formalized way of representing accounting equation. This is why a statement of financial position always have equal balances. Both the right hand side, that is the asset side, and the capital and liability side are always equal. Of course, you know that statement of financial position is not an account. It's just a statement, so there's nothing like debit or credit. It does not, the principle of double entry system does not apply in the statement of financial position. So what I'm trying to say is that the fundamental of the accounting equation states that asset is always equal to capital plus liability. But before I go into in stating the mathematical relationship of this equation, let's first explain briefly the meaning of this concept so as to help us understand deeply the meaning of the equation. First of all, let's start with the assets. So assets, let's start with the meaning of assets. As I said, assets are the properties of a business. They are the properties of a business which are expected to be of future economic benefit. Any item that is to be regarded as an asset must have the capacity to generate future revenue. If it does not have such ability to generate future revenue, it will be better regarded as an expense and not an asset. Therefore, an asset are resources controlled by an entity as a result of their past events or their past transactions from which future economic benefits are expected to flow to the entity. That is the meaning of an asset. An asset can be divided into 2. Asset can be divided into 2. We have non-current assets or fixed assets. Fixed assets as one. Number 2, we also have current assets. And so fixed, non-current or fixed assets are those assets which are expected to last long in a business, which are expected to be used in a business for more than one financial period. Example of such assets are we have plant and machinery, we have building, we have furniture and fittings, and other non-current assets. But non-current assets are those assets that are expected to be used in a business or to be consumed in the business within one financial year. So non-current assets are those assets that can easily be converted into cash. They have a high level of liquidity rate. Example of non-current asset, we talk about stock, we talk about receivable, we talk about cash. So now let's look at liability. Let's look at liability. 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 We are just trying to look at the meaning of these three concepts before we go into the mathematical expression of the equation. The liability is the claim of the outsiders on the total asset of the business. They are the amount owing. They are the amount that the business owes to the outsider. It is the financial responsibility of a business to transfer an economic resources to an outsider as a result of past event. So a liability is the claim of the outsiders on the total asset of the business. We also have two types of liability, as we have here. We have long-term liability, and we have short-term or current liabilities. Short-term liabilities. Long-term liabilities are those liabilities that can last for more than one accounting period. They are those liabilities that are expected to fall due beyond one accounting period. For example, we talk about debenture, we talk about loan. The loan can last like 2 years or 3 years before the maturity date for repayment. Well, when you talk about current liability, there are those liabilities, there are those owing that are expected to fall due within one accounting period. Of course, expected to fall due within one accounting period. Example, you talk about receivables, you talk about income prepaid and other form of a current liability. And then finally, let's look at the meaning of capital. Capital is the owner's equity. They are the amount contributed by the owner of a business in starting a business, are called the capital. So capital is the owner's net worth of a business. They are the owner's equity. They are the claim of the owner on the total asset of the business. So that is the meaning of what? Capital. So now, having looked at the meaning of this concept, let's now see how true is this equation that an asset of a business is supposed and ought to always be equal to capital plus the liability. So now, we want to talk about the mathematical relationship between these concepts. So for instance, what this implies is that if you are starting a business, and assuming that you have 10,000 naira to start a business, and you went to your supplier, and your supplier tells you that the value of the goods that you want to purchase is 10,000 naira, assuming you have the cash at hand, which is an asset, assuming it's 10,000 naira, and the value of goods you want to purchase for your business is also 10,000 naira. it means your liability will be 0. Since the value of goods you want to purchase is equal to the cash you have at hand, which is your asset, it means that the value of your liability will be 0. So the asset will also be equal to what? Capital plus liability. But in a situation whereby maybe you have 15,000 naira, so assuming you have 15,000 naira as the value of your asset, and then, but out of this 15,000 naira now, 5,000 naira out of it is the value of the motor vehicle that you want to be using and be conveying your goods. So what it implies that the amount of cash you have at hand is only 10,000 naira. So what happened now is that maybe if you went to your supplier to obtain or to get the goods that you'll be using in starting the business, if your supplier tells you that the value of the goods is 15,000 naira, whereas the amount of money or the cash at hand is 10,000 naira, then the remaining 5,000 naira now, you're going to negotiate with your supplier to allow you to pay on a future date. So that 5,000 naira now becomes the liability. That 5,000 naira that you're going to pay on a later date becomes the liability. So now the accounting equation will now be the 10,000 naira we have at hand, which you're paying immediately, becomes the capital. The 10,000 naira becomes the capital. Then the 5,000 naira, which is remaining that you're going to pay on a later date, as you agree with your supplier, becomes the liability. So at every point in time, the value of the asset will always be equal with the value of the capital plus liability. So this is what the accounting equation is trying to present, that every point in time, that the value of asset of a business concern should always be equal with the capital plus the what? Liability. Then now, going with the fundamental equation of the asset equals to capital plus liability, and looking at it from the point of view of a sole trader. Of course, you know that a sole trader provides the capital of the business all alone and also enjoys the profit and loss of the business all alone. And so, from the point of view of a sole trader, I can actually expand this equation without altering the meaning. And how do I do it? Now, you can say asset is equal to capital minus drawing plus profits. Then you bring down the liability. What this implies now is that for a sole trader, then his net worth or his total claim on the total asset of the business is capital minus drawing plus profits he made. That is net worth. That is the net worth of the business. That is his net equity on the total, or his claim on the total asset of the business. So now, in these two of them, now there's nothing different between two of them. So from here now, you can actually expand it further. When we are trying to define the meaning of an asset, we say that assets can be divided into two. You have the non-current assets and then the current assets. So I can expand the asset now to have non-current assets plus current assets. Then equals to, I also bring this one down. I'll still have capital minus drawing plus the profit. If it is a loss, remember, if it is a loss, I would have deducted it. Then bracket closes plus, and when we are trying to define liability, we also have liability is also subdivided into two. We have the long-term liability and then the current liability. So now, this place we have long-term liability plus current liability. If you look at this now, you discover that this is typical how a statement of financial position always look like. Every statement of financial position we show you at the right hand side the values of the non-current assets plus the values of the current assets, and which will be equal with the finance by side, which are the left hand side, which are made up of the capital plus the liability. So this is the typical statement of financial position and format using accounting equation. So from here now, you can see that at every point in time that the assets of a business are always equal with its capital plus liability. And again, going with this first fundamental equation, you can also actually expand it. You can also make any of the components can actually become the subject of the equation. For instance, if I say asset equals to capital plus liability, if I want to make the capital the subject of the equation now becomes capital equals to assets minus liability. What this implies is that when you take away liability from the value of the assets, it will give you the capital or the net worth of the business. But now, if I decide to make the liability the subject of the equation now becomes liability equals to assets minus capital. And the implication is also that if you take away capital from the total asset of the business, it will give you the value of the liabilities, or what they are owing to the outsiders. So this is what the accounting equation is trying to explain. But then now let's look at how true this equation is and the effect that this equation usually have on transaction, or in treating transaction in the balance sheet, or imposing transaction in the balance sheet. Let's take for instance asset equals to capital plus liability. Let's take for instance, assuming we have the following transaction. Let's look at see how it will be, let's see the effect it will have on the statement of financial position. Assuming that we have a transaction that said started business with ₦29,000 bank or cash. Assuming you have a transaction that goes like this, started business with 29,000 bank. What is the effect of this equation on this transaction, and how are you going to post it in the statement of financial position? Assuming this is your statement of financial position on your balance sheet, let's make use of balance sheet. Assuming this is your balance sheet, it will go like this. The two accounts involved in this transaction now are the bank, which are the asset accounts, and then the capital. So now, what implies that this is not as I said before, this does not follow the principle of double entry. It's just a statement and it's not an account. So it does nothing like debit or credit in the statement of financial position. So now the asset side, which is usually the credit side, will now be bank. We now have bank 29,000 naira. And so the capital, which usually represented at the right hand side, will now say capital 29,000 naira. You remember when we are trying to make an example, a situation whereby you are starting a business with 10,000 naira, and then the value of the goods you want to purchase is also 10,000 naira. meaning that liability is 0, the capital was also equal with your what? Asset. Or your asset is also equal with your what? Capital. So this is how the transaction will be represented or appear in the balance sheet. But assuming that you have another transaction, let's say the transaction says purchase of a building of a building, 15,000 naira on credit. How is it going to be represented now in the balance sheet? Now, the balance sheet now will now appear like this. It will now appear like this. Bring down the bank you have before. $29,000 naira. And this I still bring down the capital. $29,000 naira. First of all, the two accounts involved in this transaction are the asset account, which is the building, and then the creditors account. So now the value of the asset is 15,000. So at the asset side of the balance sheet, I will now write building. 15,000 naira. And then at the capital and liability side of the balance sheet, I will now write creditor. 15,000 naira. And if you want your balance sheet, 29,000 naira plus 15,000 naira will give you 44,000 naira. Have you seen it that at every point in time, that the asset side will always be equal to the capital plus what? Liability. That this is how it will continue to build up. At every point in time, your balance sheet is supposed to have an equal balance, both your right and your credit side. Assuming I have another transaction, let's say this one is purchase of building on credit. Assuming another transaction says purchase of or bought goods 4,000 naira on credit. How the transaction? Okay, bought on credit from Mr. P. Now, how is the transaction now going to appear in the balance sheet? First of all, the effect of this transaction, the two accounts that is affected in this transaction is also the creditors account, and then the asset account, which is the stock. So now, how is it going to be represented now in the balance sheet? The balance sheet now will change. It will not be. The balance sheet will now be. Bring down what I have already. Bank 29,000 naira. Building 15,000 naira. All goes to 44,000 naira. Then at the equity side, we have capital. Capital 29,000 naira. And building 15,000 naira. And now the transaction says bought goods 4,000 naira on credit from Mr. P. So we also have two accounts: the asset, which is the stock account, and then the creditors account. And so how is it going to appear now in the balance sheet? Appear now here. So now the stock is 4,000 naira. So we're going to write here. Sorry, you're supposed to be creditor. Creditor. So I will now write here stock. That because the stock is increasing, 4,000 naira. And now the liability, the creditor now is 4,000 naira. So I will add it to this creditor here. 4,000 naira plus 15,000 naira becomes 19,000 naira. So here becomes 19,000. So if we balance balance sheet or statement of financial position, it will also give us an equal balance. 29,000 plus 15,000 give us 44,000 plus 4,000 give us 48,000. 48,000. This is how the equation, the transaction will continue to build. So that at every point in time, the statement of the financial position, both the right and the credit side will always equal. This is what the accounting equation is trying to explain, that the assets of a business will always be equal with the capital and the liability of the business. So no matter the transaction you are doing, if I decide now to include more transactions, assuming I include another transaction and said, assuming now I decide to do another transaction now and said, the last one said bought goods on credit from Mr. P. If I decide to say, okay, assuming I also have another transaction that said sold goods for cash, 2,000 naira. The two accounts that are involved here is the cash account and the stock account. So now, let's see how the change that is going to occur in the statement of financial position. It is not going to be, the balance sheet is not going to be, first of all, cash, sold goods for cash, 2,000 naira. So cash is not going to be cash, 2,000 naira. I'll bring down the transaction I have here already. We have here bank, 29,000, and we have building, 15,000, and we have stock, Remember that the two accounts involved here is cash account and then the stock account. So both of them are an asset account. So but while cash is increasing, the stock is decreasing because you are selling it out. So what is now going to happen is that before we have stock here 4,000, so we are going to have under stock we have 4,000 minus the 2,000. So that the value we have here will still be 2,000. So this side, the capital and the equity portion will still be capital is equals to 29,000, and then the creditor will still be 19,000, and the both sides will still be 48,000. So this is the main principle of the accounting equation, that at every point in time that the asset portion, that the asset value of an asset should always be equal to the value of capital and liability. So this is how to build the accounting equation, or this is how to make entry into the statement of financial position with the knowledge of the accounting equation. This is the end of the video. Please, if you have not turned on the notification bell, please endeavor to do so and try to click the subscribe button. Please like the video and share. Until we meet again in another video, please bye for now.